Few expected the July budget to be so full of far-reaching measures that over the next few years will significantly change the way tax is calculated. This is certainly true for those with rental property. Key announcements included tax relief for buy-to-let interest to be restricted to basic rate only starting in 2017. 10% wear and tear allowance for landlords to be replaced in 2016-17 with relief for the replacement of furnishings, and rental relief increased from £4,250 to £7,500 from April 2016. Currently, individual landlords receive tax relief at their highest rate of income tax on all of the interest they pay to finance their letting business. From April 2017, the amount of interest that will be eligible for tax relief at the marginal rate will be restricted to the following: 75% of the interest paid in 2017-18, 50% of the interest paid in 2018-19, and 25% of the interest paid in 2019-20. The balance of the interest will be eligible for 20% tax relief in each case. From the 6th of April 2020, only basic rate tax relief will be available for interest. It is not long ago that HMRC updated its procedural manuals to clarify that the running of a rental business was no different to the running of a normal trading business. However, now the Chancellor is keen to compare the treatment of mortgage interest on rental properties with the treatment of mortgage interest on residential homes as a justification that this measure is making the tax system fairer. That does not, however, explain why there should be a difference in tax treatment between the letting of residential and non-residential property. The difference will require additional and potentially quite complex definitions. It will certainly require some clarity as to whether this measure is intended to affect mixed-use properties, such as a property comprising of a shop with living accommodation above. Will the mortgage interest apportioned to the residential part be subject to this new cap? Is the proposal intended to suggest that the letting of a commercial property is a property business, but that the letting of a residential property is not? Looking at an example, if Cliff has a rental property portfolio at present with a mortgage interest expense of £40,000 per annum, as a higher rate taxpayer, his tax saving each year is £16,000. The slide shows this reducing over the time period to just £8,000 in 2020-21. Wear and tear allowance is to be abolished, and there is no detail regarding this in the current draft of the Finance Bill. At present, a wear and tear allowance of 10% of the net rents is received in respect of fully furnished let properties. This will be abolished from the 6th of April 2016. In its place, all landlords of residential property, whether fully furnished or not, will be able to claim the actual cost of replacing furnishings. Furnishings, as an example, would be a sofa or a bed, fridges and freezers. This will need careful consideration, since is this not a return of the renewals basis for unfurnished properties and the deduction of the expense for white goods that was disallowed just 2 years ago. These two changes alone are set to cost one of my clients with student properties an additional £24,000 per annum in tax. Clearly, there is a lot more detail in this area to follow, which we will continue to follow and update to you over a period of time. If in the meantime you have any questions, please do not hesitate to get in contact with us. Thank you for your time today.